I feel like it is, but it isn't. Like, I feel like once you get a hold of it, you get a hang of the game, I feel like you'll be okay. You just gotta make sure you keep up. Yeah.
Yeah, like.
Says Amber Ball here. I think she's totally live streaming. Robert Brown. Robert Brown. Oh, I saw him this morning. Alexander.
Business, modern marketing.
Oh, okay. Drama said.
No, that was at my community college. So just I think I'm a little too late into my group switch.
Sophomore.
Junior.
Okay. Still good.
Not enough credits or enough talent.
Say. Evan. Alexander. Arthur.
They had like weight bags.
Margot. Robert Harris. Dylan. Oh, the Lycas are here. Get your Keller. Jessica. Kelly's here. Morgan's here. Eva's here. Carson's here. Carlos here. Kenny Williams. Jacob. Christopher's here. And we picked up a newsletter, or, Franco. Don't want to try to pronounce the last name here. Okay, everyone has a syllabus. Everyone knows how to get in the module. Chris, have you been in the Moodle yet? So that code and Eva, Franco needs any help. You're going to help him get in the Moodle and all that. If you get in the Moodle, Franco, no. Okay, Eva, you'll give him the code, right? Good. So everybody can get into the Moodle. And when you get into Moodle, there is a link there. How many of you went into Cengage on Moodle? So a few of you have already looked at Cengage. Should start out with chapter 11 with assignments, okay? All right, so we're on chapter 11. We're going to try to cover 10 chapters this semester. These chapters pretty much stand alone, but the 2 or 3 chapters on corporations. All right. This, I'll count your Cengage as a test grade. Okay, as 1/5 of your grade, 4 tests and then Cengage, okay? But now this first test on these first 2 chapters, it's not too bad. Then the test is a little harder on corporations. So don't get behind, especially on this first test. You want to do well on it. All right, but a couple of things on PowerPoint. The company or bank is called a creditor or a lender if you lend money to someone else. And of course, if you borrow money, you know you're the borrower. A note for over a year is long-term liability. If it's under a year, it is a current liability. All right, Any accounts payable usually is a current liability. Long-term payments might be called installments, like a mortgage is long-term, bonds payable are long-term. We'll get to those later. Installment on your vehicle, that's long-term liability usually. And notes can be issued to one of your, I guess you can borrow money and you have a notes payable, or you take accounts payable in lieu of a notes payable. So pretty much reviewing notes again, debit accounts payable and credit notes payable. This person, this company could not pay their notes payable or accounts payable on time. So they give a note. That's when you debit your accounts payable. Now their liability is a notes payable. It's still short-term liability because it's 90 days. All right, and to make sure you can calculate interest, all right, let's calculate a couple of if this thing's right. Okay, let's take a $15,000 note at 8% interest for 120 days. Go ahead and calculate the interest on that note. Just a way of review.
Yeah, I knew there was a basketball player in here.
Yeah, a lot of it. What happened to all those other basketball players in the fall? They just quit after a test or two.
They changed their major.
Well, they changed their whole major?
Yeah.
Oh, okay. All right, so Alexander, what's the interest on that note?
400.
400?
So,
Okay. Does anybody match 400? Okay. You know, you just take the principal times the rate times the time, and that's 15,000 times decimal 0.8 times 120, and we use a rounded year called a banker's year of 360. All right. So make sure you can calculate simple interest. Okay. That's all it is, simple interest. You had it in the 6th grade. Okay. And again, to review these entries for the borrower, you bought merchandise, you created accounts payable. You couldn't pay your accounts payable, so you debit that and credit note. When you pay the note, of course, you debit notes payable and you pay the interest and you credit cash. Now, if you were the creditor, you debit accounts receivable, credit sales, and then of course take care of your inventory. And here you debit notes receivable, credit accounts receivable. Just total reverses. Reverses here. And of course, debit cash, credit interest revenue, and credit notes receivable. Those are total reverse items. And if you borrow money from the bank, you just debit cash and credit your notes payable. All right. And then, of course, you pay your note and credit cash. We need to practice some of those this morning at the end of your chapter, and we'll do that. But a discounted note, it's going to let me write on it this morning. A discounted note, they collect interest in advance. So one more little problem here. Let's calculate the discount amount. It's not interest, but it's discount amount.
Bless you.
All right, let's just take a simple note for $10,000. And if you're paying 6% interest, that'd be 600 for a year. And if that were for 120 days, you'd multiply that by 1/3, which would be 200. All right, you debit cash 10,000 and your credit notes payable 10,000. If it's interest, if this is an interest rate, but if it's a discount rate, you take it out up front. You take out this 200 and you debit cash for 9,800. You debit your interest expense for 200 and you credit your notes payable for 10,000. I told you Tuesday, this is really higher than 6% because you're only borrowing 9,800. That's all you get to use or take away with. So calculate one of these and see if you can make the entry for a discounted note. Let's go with 25,000 loan at 10% for 90 days. All right, you tell me how much cash we are to debit and how much interest expense we are to debit. And credit notes payable. All right, fill in that journal entry. Okay, so how much cash do we get? What is the interest on 25,000 at 10%?
625.
All right, that's 10% of 25,000 is 2,500.
Oh, they meant.
No, that's for a year.
Yeah.
And how many days did I say it was for?
9.
And that's 1/4 of a year. So 4 into 2,500 is 6 what?
625.
Right. All right, but the note is for the 25,000 credit. So that gives us what, 24,000?
375.
375. Okay, that's a discounted note. And that's new language in this chapter. Lost the PowerPoint. Somehow I know that. Then we got down to payroll taxes, which was your next topic in the chapter. So current liabilities. There's a few other current liabilities in there, but the main one is payroll. And any deductions on payroll, okay? Has anybody ever worked in payroll? Okay, I want to give you a scenario. Margot, this is for you. You are a payroll accountant for a small firm. You have 2 kids at home. All right, you're a single mom. You need a job, right? Okay, but Margot's boss is not the owner, but he is her boss. He is over all the accounting. And he comes to her one day, he missed work yesterday. And he comes to her and tells her to go ahead and put him down 8 hours for yesterday. Do not count him not working. Okay, so Margot knows it's dishonest if she puts him down 8 hours. But Margot also knows he's sort of vindictive man. And if she don't put him down 8 hours, she may get fired. She needs a job. She got 2 kids to support. Margot, what would you do? Would you put down the 8 hours or would you not?
I would.
You take a change from getting fired?
I would, sue for wrongful termination.
Or you'd sue the company?
That would be wrongful termination.
Yeah. Well, that'd be one step. That'd be better than being dishonest. Because if he did it once, he'd keep doing it over and over and over. You get in deeper and deeper and deeper. So, or you could go to the owner if there was an owner, or you can go to the labor relations board, usually one probably in every county. But take some other step besides being dishonest. Okay. Now, that's what she says she would do, but knowing Margot, she'd give him all the hours he wanted. I'm kidding, Margot. You gave a good answer. All right, so companies don't pay in cash very much anymore. We talked about overtime, time and a half. There's a lot of jobs from home now on the computer. All you gotta do is log in and you're at work. And that's a new thing. Like the garbage collectors in New York, they have a 4-day week, 32 hours. And some companies have a 4-day week, 10 hours a day, which is 40 hours a week, so forth. So some companies, if you work over 32 hours, they'll pay you time and a half. Some pay double on holidays, double on your birthday, different policies. But the fact is the minimum wage. Now, it's proposed by some of our Congress people now, at the present, that minimum wage go up to $15 an hour. All right. Now, Morgan, what would McDonald's do if you all had to pay $15 an hour? Well, that's one thing you'd do. Would you have to lay off people? It'd make it with less people, and those who are working have to work harder, wouldn't it? So there'd be layoffs. There'd be an increase in prices. So it looks good on the surface. Somebody just says, hey, we're going to raise minimum wage $15. But there's a whole lot of economics involved. All right, some of the deductions that we will have is SIT and LIT and medical insurance, pensions. Local income tax, I don't think I know Bluefield doesn't have a city income tax on your wages, do they? Princeton don't have a city income tax, or Beckley. Now Charleston might, I don't know. Some of your bigger cities, but some cities do have a city income tax or a town income tax. But taxes, if some people are in let's say they're in a 35% tax bracket, federal, they're going to pay state 5%, and they're going to pay Social Security 7.65. All right, that's almost 50% of your wages go out to taxes. Then you go out and pay sales tax, and then you pay personal property tax. Okay, and you pay taxes on your gasoline and luxury tax on tobacco and so forth. So a lot of taxes. But the normal tax rate, even if it was 20%, that's about a third of your wages go out to taxes. So January, February, March, April, you have to work 4 months out of the year for the government. So May 1st would be tax freedom day. You paid all your tax. You worked 4 months and paid all your taxes. So that's one way to look at it, I suppose. We talked about a W-4 and and most of you fill these out, and West Virginia also has a W-4. But taxes have changed this year. I don't know what that W-4 looks like. We talked about the withholding tables. Just to review this one withholding table. Let's say you made $350 this week. Tell me what your federal taxes on it is. Take a minute and calculate that. Yes.
Jessica Mullins in here. Who? Jessica Mullins. Could you come here just a second? Nothing bad, nothing bad.
Who was that?
You need to make sure that you. Did you? Okay. All right. All right. Just want to make sure. Who's up? Hey, Bill, choose the one. All right.
All right, so what is your federal income tax withholding? When you went over to 222, your tax was $17.90. All right, $17.90. Now you subtract 222 from 350. That leaves you what, 128 times what percent? Times what?
15.
All right, you're in a 15% bracket. And what's 15% of $128?
1920.
All right, if you add 1920 to 1790, what have you got? 30 what?
30.
3710. All right, so that's figuring federal income tax from a table. And you can see the more money you make, the more taxes you pay, and the top rate was 39.8%. I think the top rate now is 37%. But now we have a new Congress lady from New York. She's proposing a 70% tax on the wealthy. All right, so if you made $1 million, you'd have to pay out $700,000 in taxes. So, will you agree with that or not? That's up to you. But these people wouldn't have the money to invest in business and industry. So, but yeah, we have a new Congress lady from New York. She's got some wild ideas.
That's to say the least.
So some of you know what I'm talking
I
about?
know exactly what you're talking about.
Okay. All right.
Oh, she's a lot more than that. Yeah, she's missing the whole Happy Meal.
All right. Here they just show you how to go through a calculation, and we have done that from federal income tax. This is doing it by another method, which I'm not really concerned with. Now, if I see a tax, we discussed that the other day, that's broken down into SS and Medicare. All right. And they're using, in this book, Social Security at 6% and Medicare at 1.5% just for ease of calculation. that adds up to 7.5. However, the real rate is 7.65. And these are the rates they'll give you: 6, 1.5. All right, total earnings, then taken out the taxes. And we talked about some other deductions from your paycheck. You know, if you live in a city, you may have parking taken out. It's expensive to park. $20 to $50 a day, probably in New York City. So you might even have that taken out with paycheck. But anyhow, okay, I've got a question for you. You're offered $2,000 a year to pay on your health insurance, or a $2,500 raise. Now, this is non-taxable. If the company pays for your health insurance, it's non-taxable. So which is the better deal for you? You want the $2,500 or do you want the $2,000 tax-free? All right. Well, if you were in 15% tax bracket in 5 states and 7.5 Social Security, let's just say 25%. You'd pay out 25% or more of this in taxes. What is 25% of 2,500? You had it calculated a minute ago, Kendrick. 650, or was it 625? 625. All right, because it's 1/4. All right, you'll pay 625 of that out in taxes, and you still got to go pay on your health insurance. So sometimes, if you're offered fringe benefits at work, it's better to take those. Do some calculation. It's better to take those than a raise. All right, if we were making a journal entry for this, we would debit salaries expense. We would credit federal income tax payable, Social Security tax payable, Medicare tax payable, retirement savings payable. They got to pay that to somebody. And then the United Fund, a charitable organization. Then you would credit wages payable. Then you're going to have to debit wages payable and credit cash when you pay the employees. Now their employer, he has an FICA tax, that's Social Security and Medicare, that's 2. He has a FUTA and a SUTA, that's 4 taxes on the employer. Now FUTA is Federal Unemployment Taxes, Tax Act, and SUTA is State Unemployment Tax Act. Now, has anybody ever drawn unemployment comp in West Virginia? Nobody? West Virginia pays one of the higher rates for unemployment comp. Okay, one of the higher dollar amounts. And it's usually for 6 months, unless your job was outsourced to Argentina. then most states extended another 6 months. Okay, so you can draw unemployment comp maybe for a year. All right, so whatever is deducted on you, the employer matches it for these 2. Now, these rates change. This one is usually 0.8%. That makes it decimal 0.008. This one, it can go higher than 5.4. 5.4 is the norm, but some states may charge 10% on the employer for unemployment taxes. Now, this rate goes up on the employer if they have a lot of layoffs. The more people they have to draw unemployment comp, the higher their rate will go up. It can go down more than 1%. A payroll register, that's illustrated in your book. and ensure. If you're doing manual payroll, you better keep up with payroll, okay? You keep down each person's name, their normal pay, their overtime pay, their total pay, and then the Social Security tax, Medicare, federal tax, retirement, miscellaneous, total, then net pay, then you give a check number, and you either debit salary or office expense. That would be a payroll register if you were doing it manual. But you know, computers help you work smarter, not harder. And this payroll register would be real easy to do in a payroll program on your computer. Even QuickBooks does payroll similar to this. All right, here's your journal entry. When you debit salaries expense, that's one main entry. And then you have, that's just another entry on salary expense. Now here's the employer's taxes. Now there are limits on these. Social Security tax, it's on the first 100 and some thousand. Medicare, there's no limit. But now SUTA tax in some states only on the first 6,000. Okay, and FUTA is only on the first 6,000 in most states. So January, February, March, if an employee has reached $6,000, you don't pay any more SUTA or SUTA. So be careful with those limits. Social Security is on 100 and something now, or SS is on 100,000. But now, Robert, if you were a pro basketball player, what are some of their salaries?
Millions. Depends. I could be LeBron and make like 125 million.
Now, but how about James? How much is he making a year?
With James Harden?
Yeah.
200 something. He got max deal. So it's like 235 million salary.
That's his contract.
Yeah.
But how much of that's for a year?
Probably like 17 million, 25 million.
25 million? Well, now, take your calculator real quick and divide 25 million by 52 weeks. See what his salary per week is.
$480,769 with 23 cents.
Now divide that by 40 hours. Let's see what he makes an hour.
It's 12,000. 19. Must be nice, too.
12,000 something an hour?
Yeah.
Now divide that by 60 minutes.
$200 a minute.
Is anybody in this country worth $200 a minute? I don't care if it's James or Trump or is anybody worth even the president of Amazon?
Nah, he just got divorced.
Well, he's going to.
He didn't have a prenup either, he's screwed.
He's screwed.
Oh,
You know what she was doing.
They just had to split about 130 billion.
Thank God they invested in Amazon.
She'll be able to live on about 75 or 80 million or what, billions, not million, billion. She'll be all right. That's the price he pays for having a girlfriend on the side. All right.
That's good.
But anyway, what did he make in one day?
In one day, 480,000.
That was a week.
$280 a week. In one day, it'll be
So,
12,000.
so
Yeah.
his Social Security is paid up the first week. All over 100,000 is Social Security tax free. So his Social Security is paid up the first week. Now, he does not work basketball season. I know they have to practice and they have to play, but he's probably got 4 months out of the year off, don't he? Okay? But anyway, seems like we get paid for skills more than we get paid for degrees. Doctorate degree will not make the kind of money that James makes.
Our clothes.
I mean, but the hard work that you have to put to make it to the pro level.
Oh, yeah. Well, only so many people have the skills that he has, and Michael Jordan or, any of these others. How about that young quarterback from Clemson, freshman? He's got some skills too, don't he?
Yeah.
All right. So he'll make it in football. All right. Now look at this second main entry. The second main entry. You debit payroll tax expense. Now you're going to be credited Social Security tax payable twice. Once on the employees, $834.12, and once on the employer, $834.12. And you're going to be recording Medicare twice. But now state unemployment tax and federal is only on the employer. And of course, all these are on the employer, but your debit payroll tax expense. That's the two main entries in payroll accounts. But now you got other minor entries. When we deposit these things, and usually all four of these can be deposited at a local bank. The employer will deposit them at a bank, and he will debit Social Security tax payable, Medicare tax payable, and credit cash. But now you need to keep a record for each employee too, whether it's on the computer or whether it's manual. And of course, this is just for John McGarth, and this is his wages, September, November, December. I guess it's, looks like it's for a quarter, October, November, December. But for the year, he made $70,000. And his deductions for the year were $30,000. Wait a minute, what did he make? Here's his yearly totals. He made $100,500. But you see, he paid $21,000 of that in federal income tax. He paid 30-some thousand out in taxes, and his net was 70-some thousand. Morgan, is yours payroll sent to a home office, or you just send the hours for each employee and they calculate the wages and print the checks? And yeah. What, per day or per week? Yeah, okay. All right, we mentioned electronic funds transfer. I believe everybody at Bluefield State is probably on electronic funds transfer. A lot of companies have went that way. It's safer. You get your money quicker. You don't have to run in and pick up a paycheck. Few people don't like that. They like to cash that check and have their money right away. That's just a stub. Okay, how about time clocks? We're talking about regular pay, and we're talking about overtime pay. How many of you all punch in a time clock? What kind of clock is it, Jimmy?
What do you mean?
Is it just a time clock? You got a card? What do you do?
Oh no, it's like almost like a phone, but because I work at UPS, but it's not really. It's like a little tablet thing. You just log in and then you punch in and then punch out when you're done.
Okay, when you log in, that is your time start. On the time clock.
Yeah.
So a lot of people are logging in on computers, and that's what you have to do if you work at home on a computer. You log in. Carson, what do you all have?
Punch card. Punch card.
Punch card. I log in. Computer. Anybody got anything different besides a punch card or logging in on a computer?
In this, I work down in business group. They have like a sheet I have to fill out.
Oh yeah, that's your school.
Yeah.
Yeah. Do you think we should have a time card in the advisor that you punch in on time? No, but anyway, companies have gotten good at it. I worked at Chrysler Corporation in Detroit one summer, and we had to have a name badge. The security guard had to look at our name badge before we punched in a time card. Make sure it was the right person. Because, could somebody else go in for you at us? Let's say you got a buddy there and you're gonna be an hour late, could he go ahead and log you in if you gave him your password and everything? Why could he not log you in?
Because I have to be able to do it.
Why do you have to be the one?
Because that's just how it is. I can't tell Tyler to do it for me and log in for me and get like an extra hour. It's just,
Now, Carson, could somebody punch through cards for you?
Yeah.
All right. Now, big companies can get away with it. Small companies, they know if you're there or not, but, here. But some companies are going by thumbprints, the log in and lock in. Some may even go as far as looking at your pupil and your eyeball to make sure you're who you are.
Jesus, it's like government.
So, but anyhow, people do cheat on payroll, okay? All right, so now, yours here would be easy to cheat on.
Yeah.
Be real easy, just fill out a time sheet, and they take your word for it anyway. And if you were absent on Tuesday, now go backtrack and check, you work 3 hours, so you can easily cheat, but don't do it wrong. Okay? All right, so time clocks, time cards, that's a part of payroll. But now, computerized payroll system is what a company of any size should use. You should not have to calculate payroll by hand anymore. All right, payroll controls, if a check signing machine is used, blank payroll checks access to the machine should be restricted. The hiring and firing of employees should be properly authorized. All changes in pay rates should be properly authorized. Some of these large corporations, a foreman or a supervisor, if an employee quit, the supervisor can still pick up a check for the employee and forward the employee's name and cash it. So all kinds of things can happen in big corporations when it comes to payroll. So they do need internal controls, just like you need controls over cash, and like you need controls over assets and merchandise inventory. Now, they mentioned a special payroll bank account should be used. And that's just debit and payroll cash and credit cash. Now, a lot of companies do that to make sure they have enough cash in there to take care of the payroll. There's nothing worse for morale than to have a check where you work bounce, is there? That'd be bad, wouldn't it?
Very.
All right, here's some other benefits that employers may provide. You might get 2 weeks of vacation pay. Most companies just treat that as another payday, and they do nothing special in accounting for it. Some set up a liability for it, vacation pay expense and vacation pay payable. That's going to take care of 2 weeks for a lot of employees. Then you would debit vacation pay payable and credit cash when you paid that employee for his vacation. All right, 2 types of pension plans. 401ks, I'm sure you've heard of that. All right, Bluefield State here gives us an option. The only retirement they have is take out 6%, up to 6% of your salary, and they match it 6%. It's put into stock plan. And most of the time it goes up, but it can go down. But some employees want more cash to take home, then they only put in 2%. And it's tax-free until you start taking it out on retirement. So if you're ever worked somewhere and the employer will match a part of your salary, try to put in the max. It will amount up. If you don't put in the max, you're losing money. You're losing their matching part. So if I just put in 2%, I'd be taxed on that other 4%, and I would be losing 4% that the college would match. So I'd be losing all the way around. So always try to take out the max. Now, are you full-time at UPS or part?
It's part-time. But I get like about 20, 30 hours a week.
They have a good retirement plan if you're there full-time. I think they have a great retirement plan.
Yeah.
But you get paid by the hour. You probably get $15 or more per hour.
$10.50.
$7.50?
$10.50.
Oh, $10.50. Okay, well, that's better than $7.50. But I thought that they'd probably pay you at least $15. But now for a full-time worker, if they were paying by the hour, what would that be?
I think it's 15 if they're full-time.
Okay, 15 full-time. All right. Pension expense and credit cash, you'd have to deposit that in a qualified pension plan, or pension expense and credit pension payable. You know what current liabilities will look like on the balance sheet: accounts payable, notes payable, salaries payable, payroll taxes payable, interest payable, all short term. Okay, and a contingent liability, that's a liability that might happen. All right. The accounting for contingent liability depends on the following: likelihood of it occurring. The likelihood that event creating a liability is classified as probable, reason, and possible. All right. You're sued. At the end of the year, you got a lawsuit pending for $100,000. This is with any company, whether McDonald's was sued for hot coffee, okay, or they were sued by somebody eating too many burgers and they got banned. They have been sued for these things, haven't they, Morgan? If the French fries are too salty, they may sue you for high blood pressure. Or whatever. Cigarette companies have been sued. You choose to smoke, you get cancer, you should sue the cigarette company. So these are contingent liabilities. Now, if it's probable that a $100 lawsuit is going to be collected, you put it on as a liability. It's going to happen. You're going to owe it. All right. Look at a couple of these. Now, a product warranty expense, that's probably going to happen. You're taking out 5% of this product, got a 36-month warranty, and you're paying 5% into product warranty expense, and you're going to credit product warranty payable. Well, when that person has a defect, he's going to bring it back, and you're going to repair it or do something to it. Here, you debit product warranty payable and you credit supplies. So you're not putting down anything for the labor, you're just refurbishing it. So on. So warranty expense is a contingent liability. All right. Now, I'm sure a lot of you bought cell phones recently. You get that warranty on your cell phone? You pay $700 or $800 or more for an iPhone. Would you get the extended warranty on it? Who's got the iPhone 10? Carson, you get the extended warranty? Morgan? All right. Do you know what that extended warranty costs? It's monthly.
It costs $8.
How much?
$8
$8 a month? Okay, $8 a month. Now, if Morgan drops her phone You still have to pay how much, even though the warranty fixed?
$30.
30? Used to be 100.
So if she drops it and she's under Apple Care, she has to pay $30. But if she breaks the phone, it's $100.
Okay, it'd be 100 to replace the whole phone. Like 100 or something. Carson is gambling. And, if he don't drop his phone, if it don't tear up, he saved $8 a month. All right?
But then if you drop your phone 3 times, you save
Yeah. But, of course, it's got a good case, don't have clumsy hands, you may never drop it. But that's a personal choice. Now, on some vehicles I get letters in the mail and calls, want me to sell an extended warranty. I never buy an extended warranty on a vehicle. Never. Now, if I bought one from somewhere and it was certified and had 100,000 mile warranty already on it, yeah, I'll take it. But I will not pay for an extra warranty on a car. Because if they want $3,000 or $4,000 for warranty, that takes a pretty big repair, don't it? Do what?
I said $4,000 on the car can do a lot.
It can do a lot, yeah.
Yeah, if we could.
All right, here's a company with kitchen appliances, and they estimate at 6% of the sales price, and a customer required $200 of parts plus $90 of labor. And here are the entries for that. When you set this up, you debit product warranty expense and credit to payable. But when the customer come in and got the repair done, you debit warranty payable, you credit supplies, and you credit wages payable. But now most of you, if you bought a new car, you would get some kind of warranty on it, of course. Well, if you buy a used car, you may get a warranty attached. If you got a contingent liability and you're not going to make an accounting record out of it, you should put a footnote on the bottom of your balance sheet. I believe we have seen these ratios before. We'll have a whole chapter on ratios, which will review these. But working capital is current assets minus current liabilities. That's WC. The current ratio is your current assets over your current liabilities. And the quick ratio, sometimes called, it's got another name, acid test ratio, but the quick ratio is usually your current assets minus at least inventory over current liabilities. So those are pretty easy. So if you had current assets of $80,000 and current liabilities of $30,000, go ahead and calculate working capital and the current ratio. Take a minute and calculate those two. Okay, what is your working capital? That gives you money to pay short-term liabilities and payroll, working capital. And then your current ratio, well, it's got to be 2 something. 2 point. All right, most companies need to be above a 2 on that current ratio. Your quick assets sometimes it always omits inventory, and sometimes it omits prepaid expenses. All right, what is your working capital here? Calculate that real quick. They've already got it calculated. Sorry about that. Current ratio is 1.7. That's below national average of 2. The quick ratio, I don't know what they're taking out, putting in here. Let's see. They're putting in cash, temporary investment, accounts receivable. It looks like they left out inventory and other current assets. All right, and that is the chapter, folks. We've looked at it somewhat twice. Now we're going to look at the end of the chapter. Turn over to the exercises on chapter 11. All right, for Tuesday, I think you ought to try the problems on page 572. Try problems 1, 2, and 5. Try problems 1, 2, and 5. But we'll look at some exercises come Tuesday, and we will look at these problems. In the meanwhile, keep up with Cengage. And okay, now how are the textbooks come along? Kendrick, you got one on the way?
I got one on the way. And I have Amazon Prime, so it should be here like tomorrow.
Are you renting it or?
Yeah, I rented it.
Same book from what? It's same book from.
Same book. You have yours?
Yeah.
You have your Cengage account code?
My phone just died.
Now, Kendrick, when you order that, you get a Cengage code with it?
Yeah.
Okay, good. Now, you get a hard copy or a computer copy?
Computer copy of it.
Those are pretty good. Let's see, I think Arthur and Eva and Billy and so they have that. Always think your organization might be a little different, finding the problem more exercise. So that'll work.
You said 1, 2, and 5, right?
Yeah, 1, 2, and 5. Who else didn't have a book? I know Carson. You got one looked up or anything? There could have been some music around.
So 1, 2, where's 5?
When they purchase Cengage, they're gonna charge you.
Oh, have what?
Oh, okay. For some reason, I thought it was 1, 2.
We have the hard copy.
Okay, that makes sense.
Oh, okay.
Okay, 1, 2.
You said,
So on Cengage, once you buy the access code, they put books, it's the same like
Yeah.
hard copy.
oh, okay, identical?
Yeah.
Okay, that's good. Okay.
There's no need for both.
And Franco, they'll give you, I'm sure you're already familiar with Amazon and all those companies. All right, so let's look at the end of the chapter. And let's look at a couple of exercises starting on page 566. All right. 11.2, take a minute on plain paper. I don't have any journal paper to hand to you. Take a minute on plain paper and do the entries for 11.2, A and B. Well, yeah.
What I don't get is just like the one that kills me. It's like I don't know, like sometimes this cash will be like, oh, debit, and then it'll be like the next level is like cash like that. You know what I mean? Like that's the thing I get. Like, how do you know where it goes? Or even it's like you see how they cast credit. In one example, it was on debit. Like I don't get like how do you know? You know what? Like that's this right here is the part that confuses me.
Okay, if you don't have a book with you, let's go along and look at the solution, I suppose, here in a minute. All right, let's go ahead and look at these journal entries and when you got started on them. Anyway, you bought merchandise inventory and you gave a note for it. So you can give a note straight out instead of accounts payable. And then you pay off that note, the $260, and you pay interest and you credit cash. Now, on the other side of the note, there's notes receivable and credit sales. Now, this person also would need to debit cost of goods sold and credit merchandise inventory. They left that entry out. And when they receive the money, they debit cash for the whole $261,625. So what the borrower credits cash for, the lender debits cash for the same amount. Interest expense debit, interest revenue credit. Notes payable debit, notes receivable credit. So it's that easy, folks. It has reverses. All right. Now, some of you don't have books, so from next week, our second week of class, let's everybody try to bring textbooks, a calculator, pencil, extra paper. Okay. Now, if you had a kid in the first grade, you'd send him to school with paper, pencil, and maybe books. Okay. All right. A couple of other exercises real quick. We'll practice a bunch of these Thursday, Tuesday, I guess. All right, let's look at number 3. Look at exercise 3. I missed my overhead. I could have put this up and showed it to you. Okay, Millie, I'm not going to let you all get away with this. Jot these amounts down. Jot these amounts down. 800,000. All right, 45 days.
How much age?
At 7%.
But I cannot hear you.
All right. 800,000, 45 days, 7%. This is 800,000, 45 days, 7%. Do the calculations. Now, these will be pretty much your same entries.
How many is?
45. Okay, folks, when you do your calculations, the same entries are on the board. This, your wife, she's observing that. 7%. All right, let's look at this one. Your debit inventory for, whoa, this was discounted. I didn't tell you that. If you had a book, you would have seen that. You take the interest out in advance. That's what was different about this one. Same entries though, but your debit cash for only $793. And your debit notes payable and credit cash, you already took care of the interest, and then notes receivable, interest revenue up front, and then you get the cash and the notes receivable. So here is an interest-bearing note, I, and here's a discounting note, D. The discount amount, and up here it's an interest amount. But discount is actually interest anyway. Okay, you know your assignments, you know you need to get a book. I'll see you Tuesday. Have a good weekend.